Beneath the neon lights of Manhattan and the glass skyscrapers of London, the real financial market is no longer human. There are no shouting traders on the floor, no paper slips flying through the air, and no gut-feeling decisions. Instead, inside quiet server rooms in New Jersey and Chicago, millions of algorithms are engaged in a silent, high-speed war. They operate in microseconds, intervals of time so small that a human blink feels like an eternity. This is the realm of the invisible hands. In this invisible arena, a single line of code can trigger a financial catastrophe. On May 6, 2010, the U.S. stock market experienced what is now known as the flash crash. In less than 30 minutes, nearly $1 trillion in market value vanished into air as algorithmic selling loops feeding on each other drove prices to near zero. Then, just as quickly, the market recovered. No human could react in time. The machine had taken control, executed the damage, and reset the board before regulators could even open their terminals. This was not an isolated incident. It was a warning. Today, over 90% of all trading volume in public equity markets is executed by algorithmic systems. These systems do not sleep, they do not feel fear, and they do not wait for the news to print. They are the market. Understanding how they operate is no longer just a technical skill. It is a requirement for survival in the modern economy. To understand where we are, we must look at how we got here. In the early days of quantitative finance, pioneers like James Simons and his legendary Medallion Fund proved that mathematics could beat Wall Street. They collected vast amounts of historical data, looked for recurring patterns, and built statistical models. These early systems were essentially massive, automated spreadsheets designed to exploit tiny market inefficiencies. But the spreadsheets of yesterday have evolved. We have transitioned from simple rule-based code to advanced machine learning models, and finally, to generative reasoning agents. Today's AI models do not just follow instructions, they formulate hypotheses. They read corporate earnings reports, analyze satellite imagery of parking lots to estimate retail sales, and monitor social media sentiment in real time. These reasoning agents can rewrite their own parameters based on incoming data. If an unexpected geopolitical event occurs, a modern AI model does not crash. It instantly recalculates its risk exposure, adjusts its portfolio, and front-runs traditional investors who are still reading the headlines. The gap between human analysis and machine execution has become an unbridgeable gulf. Most retail investors believe the stock market is a transparent public ledger, but the largest institutions trade in the shadows. Welcome to the world of dark pools, private financial forums where massive blocks of shares are bought and sold outside the public eye. Here, pension funds, investment banks, and sovereign wealth funds execute trades without moving the public market price. Inside these dark pools, proprietary AI systems execute complex stealth strategies. An algorithm tasked with selling 10 million shares of a major tech stock will not post a single order. Instead, it will slice the order into thousands of microtransactions, distributing them across different pools and executing them at varying microsecond intervals. The goal is complete invisibility. These predatory algorithms are designed to detect the footprint of other large buyers and sellers. By analyzing order flow dynamics and microsecond queue changes, an institutional AI can detect when another fund is trying to exit a position. It will instantly short the stock ahead of them, driving the price down and buying it back at a discount. It is a game of digital chess played at the speed of light. This brings us to the harsh reality of the retail investor. When you buy a stock on a popular smartphone app, you believe you are participating in a fair auction. In reality, your order is likely being bought by a high-frequency trading firm through a practice known as payment for order flow. Your retail order is valuable to them because it represents uninformed flow. The high-frequency firms use their advanced AI models to aggregate millions of these retail orders. By looking at what retail investors are buying, they gain a real-time map of market retail demand. They can slightly adjust the bid-ask spread to extract fractions of a cent from your transaction. Over billions of trades, these fractions turn into billions of dollars in risk-free profit. Trying to beat these systems using standard charts and internet news is like bringing a knife to a laser fight. The machines have structural advantages. Co-location servers placed inches away from exchange computers, microwave communication networks, and deep reinforcement learning algorithms that adapt to market volatility instantly. The retail investor is not just playing a game, they are playing against a weaponized financial matrix. So, how do we survive this shift? The solution is not to retreat from the market, but to adapt. As AI restructures the global financial market, the tools once reserved for elite institutions are slowly becoming open and accessible to the public. Retail traders must learn to deploy their own AI co-pilots, automate their risk parameters, and use algorithmic analysis to remove emotion from their decisions. The financial landscape is no longer about who has the best intuition. It is about who has the best architecture. The future belongs to those who can bridge the gap between financial intelligence and machine learning. The invisible hands will continue to move the markets, but you no longer have to be blind to their movements. Subscribe to stay ahead of the machines.